Delve deeper into it a little later on the show. Alibaba increased its share buyback program to $25 billion to target the largest ever for the China-based e-commerce giant. The move follows a slump in the stock's price on regulatory and growth concerns. Alibaba, as we can see, is up about 10.46% throughout today's trading session in New York, of course, and we did see the stock popping up more than 11% throughout the Asian trading session. Of course, as I said, we're going to delve deeper into the stocks, but first of all, let me bring to the show our next guest this morning, Brunello Rosa, CEO of Rosa Rubini Associates. Good morning, and thank you so much for joining us.
Good morning.
So Brunello, we did see 15 minutes into the trading session, pretty positive trading so far, post-Powell remarks, and in my opinion, extremely important remarks because the Fed is ready to be more aggressive from now on in terms of monetary policy, in terms of rate hikes. So what's your first take?
It's a bit of a strange situation in which equity markets celebrate tighter monetary policy by the central bank. Clearly, the bond market is not as happy. You see, interest rates, market interest rates, going up across the board, in particular in the US, but not just in the US. You see Australia, New Zealand, Europe, is widespread increase in rates. So why are equity people happy? Effectively, I believe because lots of market participants have expressed concern about this rising inflation. It's now 8% in the US, 6% in Europe, and almost 6% in the UK, just to talk about the advanced economies and similarly in developing markets. So people have expressed concern about this rising inflation. They want central banks to do something, or they want somebody to do something. Could be governments. In fact, also governments are intervening. For example, they are cutting fuel duties in some countries, such as Italy and in the UK, for example. So the fact that the central bank is ready to do something about it and be vocal about it is something that is making market participants, to some extent, happy.
I just wanted to get back very quickly on the bond market because extremely important what we do see when it comes to the short-term treasury yields and the long-term treasury yields. And of course, I'm showing to our viewers the 2-year treasury yield at 2.17. It's up about 2.83%. The 10-year treasury yield at 2.36%, which means 3.9% higher right now at 14:48 Central European Time. And this means that we are witnessing for a second day in a row major selling over there. I was wondering what is suggesting the bond market is specifically the short-term yield curve.
Well, the bond market, in particular at the short end, is effectively discounting multiple rate hikes, potentially 50 basis point hikes when and if needed, as Powell said yesterday. It could be happening as soon as the next policy meeting, and by the way, that could be in coincidence with the beginning of a trimming of the Fed balance sheet. So it's not just tapering, it's actually an active reduction of the balance sheet. If that were to be coupled with, say, a 50 basis point increase, that would be a pretty aggressive move. So the 2-year yield is signaling several rate hikes ahead. Already the Fed said that there can be 6 more additional to the one that was delivered in March, and that could be potentially an underestimate, because consider that the Fed's summary of economic projection is showing 4.1% core PCE at the end of 2022, while the Fed fund rates are expected to be 1.9%. We are talking about negative 1.2% real rate, which means that to some extent the Fed's policy is still accommodated. So the Fed has room to accelerate. Now it seems kind of an obvious response, but time will pass and things will happen. The impact on economic activity from the world and the still ongoing pandemic, let's not forget, is there, will have an impact, and Also, there might eventually be an impact on equity markets that now are happy, but eventually they will realize what it means having much higher long-term and short-term interest rates when you do discounted cash flow models. So this is the time in which the Fed might want to reconsider this aggressive stance. At the moment, it's clearly aggressive, front-loaded, is showing resolve against inflation, but time will tell whether this is a sustainable strategy.
I was wondering, what's the major risk for the global economy in the upcoming quarters? Is it only, of course, the war in Ukraine and possible negative outcome, further sanctions, for example, or it is the pandemic, or it is inflationary pressures, or probably all of it?
Yeah, it's a combination of all those things, and one tend to cause the other because the pandemic and the war create upward pressure on inflation given the disruption in global supply chain, and they also create downward pressure on economic activity given, for example, still the disruption in global value chain and global supply chain, but also because there's an impact on economic confidence, on investment programs, and so on. So this negative economic impact that we see in terms of higher inflation, slower growth, is caused by these two major factors that you just mentioned. It's very unlikely that the war will end in days. It will take weeks, most likely months. The pandemic is still ongoing. If you read the numbers, in fact, in some areas, there has never been such a high number of contagions. Now, clearly, with the Omicron variant, which is slightly milder than previous ones, perhaps the number of contagion is not as important and relevant as before, but it's still indicative because the more people get the virus, the more people might end up being in hospital and causing disruption in the healthcare that, as we know, has been the predecessor of restrictive measures. So hopefully we are not going to go back there, especially because summer is coming in the northern hemisphere. But you cannot totally rule that out. And clearly, until we have resolved the pandemic and the huge geopolitical mess that is the war in Ukraine, the world economy cannot be on a proper, strong foot.
Yeah, that's for sure. And on the other side, final take, what do you think central bankers are supposed to do? We also know that you have a large experience as an economist, so I was wondering if you had to take a decision in order to tame inflation, on the other side, trying to support economic growth, which is so far a little bit of downbeat, if we can call it like that. What are central bankers supposed to do in that kind of ambient?
It's a very complicating environment. Is the nightmare scenario for central bankers is the negative supply shock that impacts asymmetrically inflation that goes up and growth that goes down. There's a bit of a division on labor that needs to be made with the fiscal authorities that can provide some support to economic activity. But we are writing pieces exactly on this. We are doing further research because we know that the policy mix at the moment is okay in the sense that central banks are taking care of inflation and governments are taking care of economic activity. But that is just a short-term impression because if you keep the fiscal stimulus going for too long, that would be inflationary, exactly as it was inflationary during the pandemic. In the US is one of the main causes for such high inflation. So effectively, finding the right policy mix is extremely complicated. Is it possible that an optimal policy mix is not at hand, is not reachable in any circumstance, which means that we will only reach very suboptimal outcomes in terms of potentially slightly higher inflation, slightly lower growth, maybe not as many sanctions or for not as long as we would possibly desire, or we will have to give up very low long-term interest rates. So something might need to give at some point. It will take some time for economic policy authorities to find the right policy mix, assuming that there is one.
Thank you very much, Brunel Rosa, CEO of Rosa Rubini Associates. Thank you for joining us. Have a great day.
Thank you. Have a good day.